Piotr, our CEO and founder of Uncapped, and Federico Travella, founder and CEO of Newbie Gap. Good morning, both. So let's dive in, and we'll start with you, Piotr, and tell us a little bit about Uncapped, how your revenue-based financing works, and let's see, so what kind of startups you're funding and your average amounts that you fund.
Sure. So very quickly, Uncapped is now a 2.5-year-old company, and we focus on providing non-dilutive funding to startups, mainly e-commerce and SaaS companies in Europe and the US. The capital we provide them comes with no equity kicker, so we don't take any warrants, any equity. All we charge is a small fee. And then the loan is repaid in a very innovative way. So we agree with a customer the percentage of sales they share with us, and we take this percentage of sales until the loan plus a fee is repaid. On average, our loan is around £300,000, but can start from as small as 5,000 up to 10 million.
Mm-hmm. And what's the average? So that's repaid within 6 months to a year, correct?
On average, yes.
Mm-hmm. Okay, and your model is slightly different, Federico. Do you want to tell us, you began as an invoice trading startup. Do you want to explain how your model works, please?
For sure. Good morning, everyone. I'm Federico Travella, and I'm the founder and the CEO of Newbie Gap. What we are building is very much what we like to call the end-to-end working capital system that CFOs, financial directors can use to have a holistic view on their working capital. And indeed, we start off as a SME, including startups, invoice finance platform, where we provided early payments against outstanding receivables. So typically where that is relevant is if you're a B2B company selling on terms, for instance, you're a supplier of, say, Coca-Cola, and you're getting paid on 90 days, why don't you get your money today at a small discount instead of waiting 90 days, right? Over time, because of access to capital markets, because of the understanding of the industry, we've grown to become a more end-to-end system for working capital. And today we offer a number of working capital products, both on the credit side and on the technology side. On the credit side, our fastest growing products are B2B buy now, pay later. And we indeed also offer accounts receivables factoring or invoice discounting. We provide supply chain financing, and we also have a number of working capital loans or revenue-based financing options available to us. So what we try to do there is we really try to have that buffet, right? That menu that clients can leverage in their credit needs. Then on the technology side, and this is what we in fact see as our fastest growing solutions today, we believe there's a lot of value in becoming the right hand to the CFO throughout the journey of the company. So not just about startups. Our smallest companies are indeed, a few $100,000 in revenue, but our biggest client today is about 3 billion in revenue. So these are very established companies. And so we try to become wider in terms of customer segment, and our working capital solutions or SaaS solutions there are very relevant. For instance, one of our products there is dynamic discounting. So we help, in fact, cash-rich organizations that have obtained bank funding that are in a different stage of growth to optimize their working capital by providing early payments into the supply chain at a discount. So that is, for instance, an example of a non-credit product where we believe technology can be very helpful for their more established companies or companies which are a little bit more cash-rich.
Mm-hmm. So you aim to be involved in every stage of the company's journey from early
That's
to
right.
to established.
We believe strategically the RBF space is obviously very exciting because you are serving a client that is typically an e-commerce or a SaaS company. And these segments have been growing very rapidly, right? We've all seen the numbers of e-commerce exploding during the pandemic. And so naturally that customer base is growing rapidly, which is attractive also because there's a lot of new entrants, new startups, but also the existing ones are expanding in terms of revenue. So they're good clients and they're underserved by banks. And so from that perspective, it's definitely a very compelling segment. What I believe is relevant though is more the continuity of what products you can offer also in that space over time.
Mm-hmm. And Piotr, do you find the same? Do you have repeat customers, so to say? What is the ideal customer for you? Are they SaaS or e-commerce, or what is your customer profile roughly, or client profile?
Majority of customers are e-commerce customers, and yes, the customers come back very, very often. I think once you start using RBF or with social like ours, it's very hard to give up, and frankly, there's no reason to give up. Because we allow the customers to scale much faster than they would do if they try to do it organically. Because we allow you to buy inventory earlier, we allow you to spend more money on marketing. Now with all the turbulence happening on the logistics space, the clients actually need to buy even more inventory much earlier rather than moving more to just-in-time production. The same with the marketing. So we see the retention of the customers very, very high today.
Mm-hmm. But startups obviously need revenue in order to qualify, which makes e-commerce or customers with their own contracts, so SaaS, ideal for you, correct?
Absolutely.
Okay. And do you guys compete? Do you feel you compete with traditional venture capital? Like, are you another tool in the toolbox, or how do VCs feel about you?
We work very closely with VC funds. So actually, VC funds are the largest acquisition channel for us. We have a whole team dedicated to partnering with venture capital funds, and they see us as a tool which allows their portfolio companies to scale further and faster without dilution. For VC funds, taking additional equity is also very expensive because it's not only the founder who gets diluted, but the VC investors themselves. And we allow them to grow their business without dilution. Of course, at some point, the clients need another equity round, and we want them to be helpful to these founders. We believe in the long term, we will just ourselves help these companies to fundraise. We will introduce them to the appropriate VC funds because we have such a wide network, and we help these clients raise the money they need.
So a kind of handover. What's your take on that then, Federico? Do you feel like there's any kind of competition, or that you're sort of a complementary addition to the mix, the funding mix?
First, if I want to compete with VC, I will start a VC fund. That is probably the easiest way to compete with a venture capitalist. And I think the reason for that is because venture capitalist is a very specific weapon that should be used for a very specific subset of companies, right? That have a huge upfront investment in R&D, etc., that hopefully will pay off, 100x in the future. So having said that, I think no, we don't compete with venture capitalists. And again, if we were to do that, we would set up our own fund. I do think potentially that is an opportunity for the industry, for the RBF industry, and there's already some examples of that also in the US, where eventually, as public markets have been very frothy, as we've all seen in the last years, very hard to find yields. So private investing has become very popular. If you are the first to identify high growth SaaS or e-commerce companies and indeed invest equity or potentially other types across the capital structure of capital, it can become a very interesting, let's say, foot in the door RBF, because you identify leads for follow-on investment early on. So I think that is probably the most exciting part of that complementarity. And whether you then do this with partners externally or in-house, that is obviously something the industry will define. So we try to be very complementary, and in fact, most of our clients today are banked, so they do have access to bank funding. And there you do see that some companies that started, for instance, an RBF product over time, because of the cost and the impact on the margin, do eventually finance themselves with cheaper sources of funding that become available. And in the US, for instance, the market is a little bit more advanced. You start to see when companies hit a couple of million in revenue and a bit of EBITDA, they do start to gain access to bank funding. And so that's where I believe eventually my previous comment on the continuity of the product, we believe that a multi-product strategy there, also on the SaaS side with technology solutions that eventually a company can leverage over time to, and this way we very much remain relevant as a platform. Yeah.
And of course, startups have to give you full access to their data, to their back end, so to say. So you're sitting on a lot of useful data there in terms of your own proprietary algorithms to assess whether or not a startup is a candidate for funding, which must be an advantage to you in the long run.
Yeah, the early acquisition of clients is always an advantage because you start to build up data points early when incumbent banks don't have access to that. And indeed, the systems today, the APIs with ERP and other systems exist, including under open banking PSD2, that it's obviously a great enabler for this problem.
Let's talk about the downsides for a moment from the startup's point of view. Federico, I know you have something to say about actual costs for startups and risks for platforms, because it all sounds almost too good to be true that this slots into the ecosystem of funding, and it's a win-win for everyone. Is it a win-win for everyone, or as a startup, should you not get to, let's say, too addicted to round after round of revenue-based financing? Are there any dark sides here?
I think over time you need to look at the fundamentals of your business and understand what impact this product or this sort of financing has on your margin. And that's why I think the refinancing risk or that's at least what I would expect to start seeing in this industry is that the companies who can refinance themselves with banks or eventually raise follow-on funding may phase out an RBF product because of cost. That is simply the case. Now, as we've commented before, venture capital, private equity are only designed for a very specific subset of companies. Bank funding will become competitive with RBF products because of cost, and I think that is again why I believe in building more or a multi-product strategy both on the credit and technology side, which helps to provide a more continuous product for this sort of clients.
And from that to regulations, is there much regulatory scrutiny of RBF companies at the moment? Maybe one for you, Piotr.
Well, today RBF is similarly to normal business lending. In most of the countries, or in several countries, it's not a regulated activity, especially like UK, Spain, Poland. The B2B lending is not a regulated activity there. Well, on the other markets like Germany, France, Italy, it is. So it's a very country by country. But in principle, there is no like specific RBF focus regulation today. And frankly, I'm not sure there is a need for this. The truth is, I think to the point of something what Federico said, people think about RBF as a very high cost product sometimes. Well, truth is it's actually not. Like in reality is that all the bigger players, including especially ourselves, we tailor our product and proposition to the customer needs. And the product can be very, very flexible in terms of a cost, in terms of maturity, duration, repayment schedule. All these factors are customized to the customers. When the clients come to us, we not only ingest all the data from the clients, but also our team will spend a lot of time with the founder or his finance team, understand their specific pain points, their specific needs, and we make sure our solution is aimed exactly at the problems we're facing. And that's why it's such a winning product, and the customers prefer to work with us versus traditional banks or other alternative finance providers.
And of course, many of these young startups wouldn't get bank loans, so there is that.
Exactly. I think flexibility here is the key, right? It's indeed tailored to a specific subset of companies and industries. Now, one thing I've learned in the last years being in the fintech lending space is that you can't compete with banks, and so you cannot be cheaper than banks. So from the moment that a client indeed gains access to bank funding, and you compare actual APRs, not just the fee you charge as a percentage of the revenue, and they do the full analysis, then it's not competitive in terms of cost. I agree that flexibility there obviously is a very strong USP, especially for these high growth companies.
Mm-hmm. So we've got about 5 minutes to go, and I've got about 2 more questions. With all the different RBF offerings springing up, now you have to compete with each other. Yeah. What does that look like? How do you differentiate yourselves? I mean, obviously you evolve your own offerings, but what is competition like between RBF platforms right now?
Well, today clients have a lot of options, which might look very similar from the outset. The real differentiator, I think, in the long term is the level of service you can provide to the customers and the flexibility of a product. Because like money is money, but then you can say, but then there's a difference in how committed the capital is, what's kind of duration of a loan you can get, what kind of cost you can get the loans, what kind of other value add services you can get from the platform. We are very focused on a specific niche of a customers. It's 80% is e-commerce, 20% is SaaS. We focus only on these clients, and we know their needs very, very well. We know what are the obstacles that the founders are facing. We know how to help them solve them. We know we can connect them to the capital. We can connect them to the platforms they need to use. We can give them advice, strategic advice on how to run their business. And I think they know that working with us, e-commerce experts, is helping them grow their business, but help they can't get from, many of them are not VC funded. And this is like, we are the only platform which can give them this kind of support. And that's why combined with a winning proposition of a lending side, they prefer to work with us versus anyone else.
Mm-hmm. And you, Federico? How are you differentiating and competing?
I think you want to remain relevant, and what that Piotr just explained is indeed you if you're talking about e-commerce, you want to eventually be vertically integrated in that industry and become the one-stop shop for this sort of companies. And on my side, the main thing we're trying to do is to indeed remain relevant throughout the journey of either a SME or startup company, but also up till, let's say, the mid-market segment. And that's only possible with a multi-product strategy, where you provide something more than just credit. Because again, the refinancing risk is high. And so from that perspective, you want to build multiple products, both on the credit side, but also solutions which are more SaaS-like, right? Mm-hmm. I think on the pricing side and the competition side, yes, I do think that we're starting to see a lot more competition in the RBF space. So you see some players indeed are focusing on specific niches already, right? Whether e-commerce or even subsets of e-commerce or SaaS, which I think makes sense. The question more from the risk perspective over time is that, yes, e-commerce and SaaS are high growth markets, but generally speaking, if you look at this from a funding perspective, because platforms like us, we don't typically want to finance this from our own balance sheet or with the equity capital we raise ourselves, because it's expensive compared to the cost of equity. So we have external funders for that. And so raising that sort of capital will be also an important driver of eventually where you will be. Because that capital is still, is obviously excited about the asset class because they can deploy increasing amounts of money. Nonetheless, the performance is still mixed in the industry. So the credit quality is something people are still monitoring quite a bit. And from that perspective, I think sometimes diversification in terms of industries matters, because if you're only specifically focused on one single vertical, obviously if that vertical for whatever reason sees a revenue bump or is going a little bit slower, you're significantly affected. And so from that perspective, we believe being more agnostic in terms of industry. We have everything from service industries, SaaS, manufacturing, construction, etc. So we're buying very much the market, and that allows us to diversify risk significantly. And I believe that is going to be one of our drivers also on the cost side of the capital over time, where we can be probably best in class compared to others.
Fascinating. And on that note, we've reached our 20-minute limit. Thank you so much, both of you, for this introduction to RBF. It's been really, really great. And we will be watching this space. Thank you very much.
Thank you, Joe.
Have a great day. Bye-bye.
Bye.